If you've been following the stock market lately, you already know. It's been one of the wildest rides in recent memory. Interest rates shifting, AI stocks exploding, some sectors crashing, others quietly minting millionaires. And right in the middle of all this chaos, a specific group of people is not just surviving, they are absolutely beating the market. I'm talking about US entrepreneurs, not hedge fund managers, not Wall Street analysts with Bloomberg terminals. Regular business owners, founders, side hustlers who built something real, and then took that knowledge into the market. In this video, part one of a two-part deep dive, I'm going to show you exactly how they're doing it. The mindset, the strategies, the specific moves that are giving entrepreneurs an unfair advantage over the average investor. And in part two, we go even deeper, the actual asset plays, the tax strategies, and how to build a portfolio that works while your business works. Stay with me. This is going to change how you think about money forever. Let's get into it.
Why entrepreneurs think differently about money.
Before we talk about stock market strategies, we need to talk about mindset, because this is where entrepreneurs already have a massive head start. The average person looks at the stock market and thinks, I hope this goes up. An entrepreneur looks at the stock market and thinks, what problem is this company solving? Is that problem getting bigger or smaller? Who's the competition? What's the moat? See the difference? Entrepreneurs evaluate businesses every single day. That's literally what they do. They understand margins, customer acquisition, product market fit, competitive advantage, all the things that actually determine whether a stock price goes up long term. The average retail investor, they're reading headlines. They're buying based on hype. They're panic selling when things dip. Entrepreneurs have trained their brains to cut through the noise. Here are the 3 mental shifts that separate entrepreneur investors from everyone else. No, 1. They think in decades, not days. When you build a business, you know results take time. You plant seeds. You don't dig them up after a week to check if they're growing. That same patience, applied to investing, is incredibly powerful. Compound interest rewards patience above all else. No. 2. They buy what they understand. Warren Buffett's most famous rule, never invest in a business you don't understand, is second nature to entrepreneurs. A founder who runs a SaaS company immediately understands Salesforce, HubSpot, or Adobe's business model. They know what net revenue retention means. They know what makes those businesses defensible. No. 3. They see volatility as opportunity, not danger. Every entrepreneur has lived through hard times in their business. Cash flow crunches, slow months, failed launches. They've learned that downturns are temporary and that the people who keep going, or better yet, double down, come out ahead. When the market drops 20%, the average investor freezes or sells. The entrepreneur thinks, everything just went on sale. This mindset alone is worth more than any specific stock tip I could give you. Part 2. The insider advantage. Using your industry knowledge. 6 men. Now, let's talk about one of the most powerful and most underused advantages that entrepreneurs have in the stock market. You already know your industry better than 99% of investors. Think about that for a second. If you run an e-commerce business, you understand consumer behavior, supply chain dynamics, logistics costs, and digital advertising trends at a level that most analysts sitting in New York offices simply don't. If you're in real estate, you feel market shifts before they show up in the data. If you're in healthcare, tech, food, construction, whatever your space is, you have ground-level intelligence that is genuinely valuable. Let me give you some real examples of how entrepreneurs have used this in 2025. Example 1, the logistics founder. A founder who runs a third-party logistics company noticed in early 2025 that shipping rates were quietly ticking back up after 2 years of deflation. His clients were complaining, his own costs were rising. He recognized this as a systemic shift, not a one-month blip. Before the mainstream financial media picked up on it, he had already increased his position in freight and logistics-related stocks and ETFs. By the time CNBC ran the story, he was already sitting on significant gains. He didn't have insider information in the illegal sense. He had contextual intelligence, the ability to read industry signals that the average investor can't see. Example 2, the restaurant group owner. A woman who owns a regional restaurant group noticed that a major national chain was quietly closing locations near her stores. Not just one or two, dozens. She cross-referenced this with commercial real estate data and found that the chain was also letting go of prime locations. She shorted the stock before the earnings call revealed the trouble. Again, not illegal insider trading. Just smart, pattern-based thinking that entrepreneurs naturally develop. How do you apply this to your industry? Here's a simple framework I call the operator's eye. Step 1. List the 10 biggest public companies in your industry or adjacent to it. Step 2. Every quarter, ask yourself, based on what I'm seeing on the ground, are these businesses getting stronger or weaker? Step 3. Compare your ground-level read to Wall Street's consensus. When there's a gap, that's your opportunity. This isn't complicated. It's just paying attention to what you already know and connecting it to publicly traded companies. Section 3. The portfolio strategy, how entrepreneurs structure their investments. Second taximinen. Okay, let's get into the actual money strategy. Entrepreneurs who are beating the market in 2025 aren't doing it by picking one magic stock. They're doing it with a structured portfolio approach that balances risk intelligently. Here's the framework most successful entrepreneur investors are using right now. I call it the 70-20-10 model. 70%, core stable foundation. This is the boring part. And boring is beautiful. 70% of your investment portfolio should be in broad, diversified index funds and ETFs. Think S&P 500 index funds, total market funds, dividend ETFs. Why? Because even entrepreneurs who beat the market in specific bets still want a stable base. This 70% grows steadily, requires zero management, and protects your overall wealth. Here's the key insight most people miss. You don't have to beat the market on 100% of your money. You just have to beat it on the portion where you have an edge. 20%. Strategic sector bets. This is where your industry knowledge comes in. 20% of your portfolio goes into sectors and individual stocks where you have a genuine informational advantage, the industries you work in, the trends you see firsthand, the technologies your business already uses. In 2025, the sectors where entrepreneurs are finding the most alpha, meaning returns above the market average, are AI infrastructure and tooling defense and cybersecurity. Healthcare technology, U.S. manufacturing and reshoring plays commercial real estate recovery. Now, you don't just blindly invest in these sectors, you invest based on your specific knowledge. If you're in tech, your 20% looks different from a healthcare founder's 20%. 10% high conviction moonshots. This is the fun money. The 10% you can afford to be aggressive with. This is where entrepreneurs put individual company bets, emerging tech, small caps they've researched deeply, or even pre-IPO opportunities through platforms like Forge or EquityZen. The 10% rule is critical. It means that even if your moonshot goes to zero, which can happen, you've only lost 10% of your portfolio. But if it 10x's, it moves your overall portfolio by a significant amount. Most retail investors get this backwards. They put 80% in risky individual stocks and 20% in safe stuff. Entrepreneurs flip it. Safety first, aggression targeted. Section 4. The cash flow advantage. Reinvesting business profits strategically. 599. Here's something the financial media almost never talks about. And it's one of the biggest reasons entrepreneurs build wealth faster than salaried investors. Entrepreneurs have multiple cash flow streams to invest from. A regular employee has one source of investment capital, their paycheck, after taxes, after living expenses. Whatever's left, maybe a few hundred or a few thousand a month, goes into their 401k or brokerage. An entrepreneur has business profits, owner's salary, or distributions. Tax savings from write-offs, which we'll cover in Part 2. Potentially, proceeds from selling equity or businesses. This means entrepreneurs can invest more and invest smarter because they control when and how money flows. Here's how the smartest entrepreneur investors are using this in 2025. Strategy 1. The Profit First Investment Rule. Every month when the business hits its profit target, a fixed percentage, typically 10 to 20%, goes directly into the investment account, not after personal expenses, not whatever's left. First. This is the business equivalent of paying yourself first. Strategy 2. Market timing with business cycles. Entrepreneurs understand their own business seasonality. A retail business owner knows Q4 is their best quarter. They plan ahead, keeping more cash liquid in Q3 so they can invest heavily during any market dips that often happen in October and November. They're not timing the market emotionally. They're aligning investment capital with their own known cash flow cycles. Strategy 3. Using business credit, not personal credit. Some sophisticated entrepreneur investors use business lines of credit during market corrections to increase positions, then pay them off quickly as the market recovers. This is advanced, it carries risk. But when done carefully with short time horizons, it's a lever that salaried investors simply don't have access to. The bottom line, your business isn't just a source of income. It's a wealth-generating machine that feeds your investment engine. Most entrepreneurs underestimate this connection. Let's bring part 1 together. We've covered the mindset that gives entrepreneurs an edge, the insider advantage of knowing your industry, the 70-20-10 portfolio structure that balances safety and aggression, and how to use your business cash flow as a wealth accelerator. This is the foundation. And if you apply just these principles, you're already ahead of 90% of retail investors. But part 2 is where it gets really powerful. In part 2, we're going deep on the tax strategies that can literally double your net investment returns. The specific asset classes entrepreneurs are flooding into right now. How to evaluate individual stocks like a founder, not a gambler. And the mistakes that cause entrepreneurs to lose their market edge. Keep watching. Part 2 starts right now. We go deeper into the mechanics. I'm talking about tax strategies that most CPAs don't even bring up, the specific investments that entrepreneur-heavy portfolios are loaded with right now, how to evaluate a stock the way a business operator would, and the common traps that cause even smart entrepreneurs to underperform. Let's not waste any time. Let's go. Section 5. The tax strategies that supercharge investment returns. 7 Min. I want to start part 2 with something that most investment videos completely ignore, and it might be the single most high-leverage topic in this entire video. Taxes. I know, not exciting, but follow me here, because this is where entrepreneurs gain a massive structural advantage over every W-2 employee investing in the market. Here's the truth that most people don't realize. Your investment return isn't what you make. It's what you keep after taxes. An average investor earning 12% annually but paying 37% in short-term capital gains tax is actually keeping about 7.5%. An entrepreneur using the right tax structures on the same investments could keep 10 to 11% on the exact same trades. Over 20 years, that difference is the difference between retiring comfortably and retiring wealthy. Here are the top tax strategies entrepreneurs are using in 2025. Strategy 1. The Solo 401k or SEP IRA. If you're self-employed or own your business, you can contribute up to $69,000 per year into a solo 401k in 2025, compared to $23,000 for a regular employee 401k. That's $46,000 more per year growing tax-deferred. Over 20 years at 10% average annual return, that difference alone compounds to over $2.9 million in additional tax-sheltered wealth. And the contributions reduce your taxable income, meaning your tax bill goes down the same year you invest. This is one of the most powerful and most underused tools available to entrepreneurs. Strategy 2. Opportunity Zone Investments. The Opportunity Zone program, created under the 2017 Tax Cuts and Jobs Act, allows investors to defer and reduce capital gains taxes by reinvesting those gains into designated economically distressed areas. In 2025, with capital gains from AI stocks and real estate sales hitting many entrepreneur portfolios, Opportunity zones are becoming a very popular play. The potential benefit: defer capital gains taxes, reduce the taxable gain by up to 15%, and pay zero capital gains on new appreciation if held for 10 years. If you've had a big exit or a big year in the market, this is a conversation to have with your CPA immediately. Strategy 3. Tax loss. Harvesting at the business level. Entrepreneurs who operate in multiple entities often have more flexibility to time the realization of gains and losses across their portfolio. By strategically selling losing positions before year-end to offset gains, and then buying back similar but not identical positions, they reduce their annual tax bill without meaningfully changing their investment exposure. This is standard practice, but entrepreneurs can do it more aggressively because they have more control over their income timing than salaried employees. Strategy 4. Qualified Small Business Stock, QSBS. Exclusion. This one is a game changer for entrepreneurs who invest in early-stage companies. Under Section 1202 of the IRS Tax Code, if you invest in a qualified small business and hold the stock for more than 5 years, you can exclude up to $10 million, or 10 times your original investment, in capital gains from federal taxes, completely tax-free. Angel investors and entrepreneur investors who put $500,000 into the right early-stage company and then see it grow to $5 million could owe zero federal tax on that $4.5 million gain. Zero. This is why sophisticated entrepreneurs are allocating a portion of their portfolio to early-stage companies through angel networks and equity crowdfunding platforms. The tax code, when used strategically, doesn't just reduce your tax bill. It multiplies your effective investment returns. Section 6. Asset Classes. Entrepreneurs are investing in right now. 6 Min. Let's talk about where the money is actually going. In 2025, entrepreneur-heavy investment portfolios look noticeably different from what financial advisors traditionally recommend. Here's what's standing out. Asset class number 1, AI infrastructure stocks. Entrepreneurs who run businesses are living the AI transformation in real time. They're paying for compute. They're buying software subscriptions. They're watching their own productivity change. And the most sophisticated of them have recognized that the picks and shovels play in any gold rush is to own the companies selling the tools. In the AI era, semiconductor companies, cloud infrastructure providers, and enterprise AI software platforms are where entrepreneur investors are heavily positioned. The thesis is simple. AI adoption is still early. The infrastructure build-out is multi-decade, and the companies at the core of it have durable competitive moats. Asset class number 2, private credit and business lending. As traditional bank lending has tightened since the 2022-2023 rate hike cycle, a gap opened up in small and mid-market business lending. Private credit funds and business development companies, known as BDCs, stepped in to fill that gap, and they're paying yields of 9 to 12% annually in some cases. For entrepreneurs who understand credit risk because they've lived it, who know what a healthy business balance sheet looks like versus a stressed one, BDCs are a natural fit. You're essentially lending to businesses like yours, with your business expertise acting as your due diligence edge. Asset class number 3, cash-flowing real estate via REITs. Rising interest rates hurt real estate valuations from 2022 to 2024. But as rates stabilize and begin to decline in 2025, commercial and residential REITs, real estate investment trusts, are recovering. Entrepreneurs love REITs because they generate regular income, require no active management, offer diversification across hundreds of properties, and trade like stocks, meaning liquidity that owning physical property doesn't have. Industrial REITs, data center REITs, and residential REITs are particularly popular in entrepreneur portfolios right now. Asset class number 4, their own business. This one sounds obvious, but many entrepreneurs dramatically underinvest in their own business relative to outside markets. Think about it. If you can deploy $50,000 into your own business and generate a 40% annual return through better equipment, hiring a key person, or a marketing campaign, Why would you put that same $50,000 into an index fund returning 10%? The smartest entrepreneurs treat their own business as their highest returning asset class and invest in outside markets with capital that exceeds what their business can productively absorb. Knowing where that line is, when your business is fully capitalized and additional investment hits diminishing returns, is one of the most important financial decisions an entrepreneur makes. Section 7. How to evaluate a stock like a business operator. 5 minutes. Now let me give you a practical framework for evaluating individual stocks, the way a business operator thinks, not the way a typical retail investor thinks. Forget technical analysis. Forget chart patterns. Forget trying to predict short-term price movements. Here's the operator's stock evaluation checklist. 5 questions every entrepreneur should ask before buying a stock. Question 1. Would I want to own this entire business? Not just buy some shares. If someone offered you 100% of this company at the current valuation, would you take it? This forces you to think like an owner, not a trader. It cuts through hype immediately. Would you want to own a business with this revenue, these margins, this management team, this competitive position? If the answer is no, don't buy the stock. Question 2. What is the moat? Every durable business has something that protects it from competition. A strong brand, network effects, switching costs, cost advantages, regulatory protection. What is this company's moat? Is it getting stronger or weaker? A company with a shrinking moat is almost always a bad long-term investment, regardless of current profitability. Question 3. Is management building or extracting? Great management teams reinvest profits to compound the business. Bad management teams extract value through excessive compensation, wasteful acquisitions, or financial engineering. Read the annual report. Look at how management talks about capital allocation. Are they buying back shares intelligently? Are they investing in R&D? Are they making acquisitions at reasonable prices? Management quality is often the difference between a good business and a great long-term investment. Question 4. What does the unit economics look like? Entrepreneurs understand unit economics instinctively. Customer acquisition cost, lifetime value, gross margin per unit. Apply the same lens to public companies. Is the cost to acquire customers going up or down? Is the lifetime value of customers increasing? Is gross margin expanding as the business scales? Improving unit economics is a sign of a business getting stronger. Deteriorating unit economics, even with growing revenue, is a warning sign. Question 5. What's the price I'm paying for this quality? Great businesses bought at terrible prices make terrible investments. Look at price to earnings, price to free cash flow, enterprise value to EBITDA. You don't need to be a financial analyst. You just need to compare the company's valuation to its peers and its own historical range. Buying great businesses at reasonable prices and holding them for years is the simplest path to beating the market. Section 8. The mistakes that destroy entrepreneur investors. For men. Now, I'd be doing you a disservice if I only told you what works without warning you about what destroys entrepreneur investors, because the same traits that make entrepreneurs successful in business can absolutely wreck them in investing if they're not careful. Mistake number 1. Overconcentration. Entrepreneurs are used to going all in. You don't build a business by half committing, but investing everything in one stock, even one you know deeply, is a catastrophic risk. The market has humbled people far smarter than both of us. Diversify. Always. Mistake number 2. Confusing familiarity with an edge. Just because you use a product doesn't mean you truly understand the business. Millions of people use Peloton products and bought the stock because they love the bike. Loving a product and understanding a business's competitive position, cost structure, and balance sheet are very different things. Make sure your edge is real, not just enthusiasm. Mistake number 3. Neglecting the portfolio. While the business is hot, when business is booming, it's easy to ignore your investment portfolio. Set it and forget it becomes forgot it entirely. The problem is that concentration happens through neglect. If one stock runs up dramatically, your portfolio becomes unbalanced without you noticing. Rebalance at least twice a year. Mistake number 4, using business stress capital to invest. Never invest money you might need for your business operations. Emergency funds, operating capital, and investment capital should be completely separate. Entrepreneurs who invest their operating reserve and then face a business cash crunch are forced to sell investments at the worst possible time, usually during a market downturn when they need liquidity most. Keep those buckets completely separate, always. Final section. The 90-day action plan, 2MN. Let me leave you with something concrete. A 90-day action plan to start applying everything we've covered today. Days 1 to 30. Foundation. Audit your current financial position. How much business profit are you generating monthly? What are you currently doing with it? Open a solo 401k if you don't have one. Set up automatic investment transfers so a fixed percentage of business distributions goes straight to your brokerage. Days 31 to 60. Strategy. Build your 70-20-10 portfolio structure. Define your core index fund positions. Identify the 5 to 10 public companies in your industry that you understand deeply and want to research further. Start reading one annual report per week. Days 61 to 90. Optimization. Meet with a CPA who specializes in business owners, not a general tax preparer. Discuss the solo 401k contribution maximum, opportunity zones if relevant, and QSBS positioning for any angel investments you're considering. Get your tax strategy aligned with your investment strategy. Then, stay consistent. Invest every month. Review quarterly. Rebalance twice a year. That's it. No magic, no shortcuts. Just the systematic application of your entrepreneurial edge, combined with the right structures, the right assets, and the discipline to stay the course. Outro 1.5 Menami. You made it through the full 50 minutes, and honestly, if you absorbed everything we covered today, you are more financially equipped than 95% of investors in this country. Let me do a quick recap of everything we covered. In Part 1, the entrepreneurial money mindset, using your industry knowledge as an investing edge, the 70-20-10 portfolio model, and leveraging business cash flow to invest smarter. In Part 2, tax strategies that multiply your real returns, the asset classes entrepreneur portfolios are loading up on in 2025, how to evaluate stocks like a business operator, the mistakes to avoid, and your 90-day action plan. This is the roadmap. Now, it's on you to execute. If this video gave you value, subscribe, because we publish videos like this every week, built specifically for entrepreneurs and investors who want to build real, lasting wealth. Drop a comment below. What was your biggest takeaway from this video? I read every single comment. Until next time, keep building, keep investing, and remember, the best businesses and the best investments share the same foundation: value, moats, patience. See you in the next one.